This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jonathan Farrow and Lisa Abramowitz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. John Stolfus joins, Chief Investment Strategist at Opco Oppenheimer Asset Management, and we speak to him about the bull market he nailed last year and continues to nail this year. John, I'm going to take it back to the analog of the middle 70s, a horrific recession, the leap in 1975, and then a follow-on in 1977. Is 2024 a follow-on bull market?
I think in many ways it is, Tom. I think the question here really is, or rather the difference is, it's a substantially different background in terms of a digitalized global society for business and the consumer, and what was back then, which was essentially an analog world. And I think things get digested much quicker. I think that the data is of better quality. And because we've been in crisis, in and out of crisis since 2008, all the players, as well as the traders, as well as the investors, are more experienced with dealing with volatility.
John, I think what's so important here is only Stolfus is talking about last year was a prelude. I just think that's so important.
5,200 price target. Yeah. Year end this year. John, let's build on that. You and I have talked about this a few times in the last few months, and I've appreciated it. Can we just address it right now? How dependent that call is on interest rate cuts from the Federal Reserve?
Not much, really. We're not of the camp that's looking for 6 cuts this year in 2024. We're looking for perhaps 1 or 2. And we're not looking for the first half for cuts. We think it'll happen in the second half of the year and likely later rather than earlier in the second half. To us, the Fed has been remarkably sensitive in practicing its mandate, for a stable economy and full employment as described by unemployment between 3% and 4%. And we think it wants to keep it that way. And so that's what we're looking at. We're a little bit different. We like the Fed, ironically. Very few people do. We think the Fed has done, it shows the Ben Bernanke legacy carried on through Jerome Powell in the sense of communication and clarity.
So it might not necessarily, the rally might not be dependent on Jay Powell, but how much is it dependent on the central bank of Tim Cook?
I would have to say perhaps I'll keep it away from company specific here, but I would say certainly a business, the consumer, and the jobs market will play an important role this year. Key word to watch for is resilience. When we look at economic data, what we're looking at is for things to show resilience, and what naturally is a challenging environment when you're making transitions, when you have the levels of trouble around the world. The geopolitical risk just seems to keep ramping up by the day. But consider where business plays out in this, where the opportunities are, both the cyclical point where we are on the calendar, as well as the secular trends that are driving potential growth for all 11 sectors.
Okay, so in other words, does tech still lead? I mean, I guess that's the question at a time where that accounted for 15% of the 24% gain of the S&P last year.
Lisa, I think tech certainly remains a major participant in this. But I think what we need to watch, well, of course, communication services, which is about 50% tech related. You also have, when you look at the other sectors, just think about industrials and all the technology in that. And it's a good customer of technology, whether it's sensors or robotics or what have you. And the cloud, big data, and all that AI. So when we look at this, whether it's a utility company, whether it's a materials company, whether it's a pharmaceutical or a biotech, technology is where it's at. Right. So we can't but think. The other reason is last year tech was fabulous in its performance because it had been so brutalized in 2022 when the bears sold all of tech. The long duration they sold because they were worried about financings, but they sold the good stuff that was highly profitable, positive cash flow, great products, and deeply embedded in the lives of business and the consumer.
John, the cliche is the boat has left the dock. I would guess a very large percent of the surveillance audience feels like they missed 2023. How do you get back in the game if the boat's left the dock?
Yeah, Tom, I would say for the people who missed this, I would say it's a question of layering in. It's not back up the truck at these levels. Consider opportunities that show up when you get some weakness in names that may have gotten away from you. Look for babies that get thrown out with the bathwater in downdrafts to add to positions that you're building. And in essence, what you want to avoid is just blindly buying dips. You want to be selective, even within what appears to be a nicely broadening rally after, as Lisa pointed out earlier, I mean, we're still back to the future in terms of the prices of stocks in many cases outside the Magnificent Seven. And even there, they've got, it would look like they've got plenty of headroom available to move higher. In
so many ways, we had a decade in a year, as Lisa and I discussed a little bit earlier on the program. John, wonderful to catch up with you, sir. Happy New Year. John Stolfus there of Oppenheimer Asset Management.
Right now, we need perspective, and we get it from someone gifted. He's served the nation in the Marine Corps, also a White House fellow. And critically, he is a king of speculative fiction with James Stavridis. Elliot Ackerman's must-read 2034. Boy, is that a must-read right now, given the Philippines, given the South China Sea. And we eagerly anticipate 2054 that you'll see in March. Elliot Ackerman joins us this morning. Elliot, this is not speculative fiction. It is reality in the Red Sea. What is lost in the press coverage?
Yeah, I think the one thing that is often lost is we have a tendency to focus kind of specifically on military events while losing perspective that all military events happen in a political overlay. Ultimately, these are political questions. What's going on in Taiwan? What's going on in Ukraine? What's going on in Israel? And the longer these wars play out, the more and more central the politics of the war itself become and what the outcome is going to be.
The heart of your fiction with Admiral Stavridis is things happen suddenly and then in sequence. Do we have the ships in place against these terrorists, whatever you want to call them? Do we have the process in place where unexpected bad things can happen in sequence?
I think when it comes to the Middle East and the challenges that we're seeing there, yes, we do, and that is a situation where we the United States, vis-a-vis the Iranians, we are not facing a peer-level adversary necessarily in Iran, and I agree with Terry's comments that the underappreciated conflict here is Taiwan. And when it comes to Taiwan, the United States does not have the forces in place, at least peer-level forces in place that could meet Chinese aggression across the Taiwan Straits. And that's one of the huge challenges that we face, is that the Chinese would be fighting that conflict in their backyard, and we would be fighting it from across the Pacific Ocean.
I want you to elaborate a little bit on the point that you just made, that all of these international conflicts have real domestic political implications. What are some of the ramifications that we've seen over the past year, how the conflicts have developed, and how public opinion has shaped the inaction that we're currently seeing in Congress to continue providing aid?
I think when we go around the world, if we look at Ukraine right now, I would argue that that's probably a war that's not going to be decided on the battlefield as those conditions stagnate. It is a war that's going to be decided at the ballot box. And I think in Israel, as we see this war is now extending into months, I think domestic political considerations in Israel are going to determine the outcome of their war with Hamas. And I think when we look at the United States, the elephant in the room is we have an election that's going to occur this fall. And how that election unfolds will be determinative to those conflicts. And lastly, when we look at Taiwan, in 2 weeks, the Taiwanese people are having a presidential election, and the outcome of that election will certainly affect China's perceptions on what they should do in Taiwan.
How different is the foreign policy of Donald Trump versus President Biden?
I think the foreign policy of Donald Trump is much more unpredictable. And I think the foreign policy of Joe Biden, as we've seen it, is much more and has a much more incremental. So I don't think anyone can necessarily say what Donald Trump's policies would be on any three of these conflicts, Taiwan, Ukraine, or Israel, whereas I think we've seen sort of a more consistent approach that Joe Biden has applied.
I mean, I look, Elliot, at where we are, and it's about public service. There's a lot of people watching this across this nation that have loved ones at sea, loved ones on long tours of duty. I know that the Ford is coming back from the Mediterranean. Are we fit now in our defense budget for multiple wars? You mentioned Taiwan. Let's take our war Ukraine, our war Iran, maybe our war China. Do we have a budget near capable of meeting those three threats?
I think we have to take a very, very hard look not only at the budget and the financial resources that we're applying, but also the intellectual resources, and that's actually where I have the most concerns. Would a war against China look like a repeat of the Second World War, in which the coin of the realm in naval battle were aircraft carriers? 80 years after the aircraft carrier became the coin of the realm. And I don't know that that's necessarily the case. We've seen in places like Ukraine that the Ukrainians have been very effective in sinking Russian ships of the line with shore-based missiles. And so, I'm a Marine veteran. My own service right now is in the midst of doing a real strategic reset about what it would look like to fight a revisited island hopping campaign in the South China Sea. And they're restructuring the entire Marine Corps to do that. So I think there's a budgetary question, but there's also an intellectual question of, what will the wars of the future look like? And that work needs to be done now, and it's going to force some American military institutions to transform in ways that are going to be very uncomfortable.
With the war of the future, Elliot, what's a more effective strategy? One that's predictable or one that's unpredictable?
Well, I think in terms of your battle plans, you always want to be unpredictable. The word I would use is one that is adaptive. Because it's very difficult to predict what the war of the future is going to be. It's most essential not to get the prediction right, but to get the posture right, so that your forces can adapt to whatever the next conflict looks like. And to use an analogy from the Second World War, at the outset of the Second World War, in terms of naval warfare, again, the coin of the realm was the battleship. And it had been the coin of the realm, the most essential platform for centuries. But as we all know, Pearl Harbor, the entire U.S. battleship fleet was sunk, and we had this new platform, which was the aircraft carrier. And that platform was able to adapt and become the central force around which naval battles were fought. And I think whatever the next war is, we're going to see a similar process of adaptation need to occur. It's going to have to occur very fast, and the side that gets it right will probably be the side that wins.
Elliot, just to finish there, what do you suspect it is?
I think it's going to probably be a network of platforms. I think it's going to be unmanned ships, unmanned aerial vehicles, our ability to fight both a high-tech war and also a hybrid low-tech war when many of those high-tech systems are taken offline, and our forces' ability to kind of toggle between the two. So it's going to be very, very complex, but more of a network-centric version of warfare as opposed to a platform-centric version of warfare built around, very big ships and aircraft and things of that nature.
Interesting. Elliot, thank you. Appreciate your time this morning. Always do. Happy New Year, sir.
Thank you.
Elliot Ackerman there.
Happy New Year.
U.S. Marine Corps veteran. With us around the table, Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods. Sarah, good morning and Happy New Year.
Good morning, Happy New Year to all of you.
Let's revisit that quote from Barclays this morning. We believe the continued period of weak results coupled with multiple expansion is not sustainable. Are you on the same page?
I think you almost have to be. I mean, the theme for 2023 was all about the Fed and what was going to happen. And as soon as the cycle peaked, you could be okay. So if we pulled forward a lot of multiple expansion on the back of the idea that rates are going to come down, they're probably not going to come down to that great financial crisis level. If they come down a couple hundred basis points, is the multiple expansion already too much? And I think that that's going to be the big tension in a lot of them. And, for Apple, which we were talking about, you've got to look at all that consistency and all that cash flow. And that's what people are paying for, that and the exclusivity majority of it's Apple, and people will keep replacing those products.
Is that assessment true of the whole market, of just a select group of stocks that dominate the market?
I think it's more a select group. I mean, you have to, I think valuations, and we keep saying, it's almost like this is Europe's year. This is valuations year. It's going to matter this year, right? I don't know when it's going to matter, but at some point it will. I think having money have a cost makes valuations matter in a way that we had 15 years where, people talked about it, but it didn't really matter. Maybe that starts to happen now, and maybe people really start looking at those metrics. But I think you've got a lot of money on the table, and you've got a lot of places that, got a lot of money that needs to be invested.
Frame out total return. You could go to the Bloomberg folks, the terminal, TRA is the function, and you can model in annual return quickly, 1 year back, 2 years back, 3 years, etc. And the answer is we're now addicted to, I made 15%, I failed. Baloney. It's a single-digit return. At the most, you're going to make 11%, but the answer is, do we need to get used again to equity return of 8 or 9%?
I think that you do, and I think that you also have to look at history. I mean, yes, you had a huge move last year in a handful of names, and yes, some of the other stocks started to catch up at the end of the year. I was just looking at a chart of L3 Harris before I come on here, and I was like, wow, that back end of the performance was really, really quick. I don't know where you end up with multiples here, but I don't think that you can have the kind of growth that we've had given the kind of economic backdrop that we're looking at. If the Fed's really going to cut 6 times like the market is pricing in, then we probably have a much weaker economic scenario than earnings are pricing in. So there's a tension here, and 2024 has got a lot of questions that need to be answered.
You're the person I've been wanting to ask this question to. One of the big surprises last year was that the great underperformance came from oil. Tom and John were talking about why that was so surprising, considering some of the conflicts that really were escalating in the Middle East. At this point, we are seeing oil perk up just a touch in relation to what's going on in the Red Sea. Could this increase, if it continues, change the disinflation narrative?
Absolutely. I mean, just changing the trade routes alone could change some of that because you're going to have things get more expensive. But you've had a huge supply response to oil demand. And you were talking about earlier, the U.S. is a huge producer now, right? Commodities are priced on the margin. If I've got excess supply, I can't get prices to really move that high, which is why the Saudis have had to keep taking oil off the market. But if you start to see a crimping of some of those routes and you can't move things the way you thought you could before, then you could see some problems. And that's been a huge help for the inflation picture. And if that changes and you start to see data that is a little bit more inflationary, that narrative on how much the Fed's going to cut has to change. And then that's going to be a question of where do equity multiples go, given that scenario.
I know that you were bullish on energy stocks through the beginning of last year. Then you got a little more tepid as you saw some of the moves. At this point, how much are you leaning in to some of those names because of just how offsides people would be if the disinflation narrative fades and oil prices surge?
Well, we think of energy as an area where you need to have some position, but you trade around that position. And you get heavier when you think that you've got an opportunity, and you get lighter when you think that the market is not going your way. When the supply came up a lot, that's where you sort of lighten up on your energy positions. I don't think you want to be out of it entirely. You've got a lot of very good dividend yields in those, and you've got a lot of stocks that act better in a bad market than some of the other things do. So I think that's something you want to trade around, and we still think that energy has a longer tail.
You've got a barbell portfolio. You've got the short-term stuff where you're day trading. We know you're famous for that, Sarah. And then you got the buy and hold. I want you to talk to the audience that their heads are spinning off of COVID. They're stating, okay, COVID's over. Can I maintain some form of 3-year or 4-year or 5-year ownership of whatever equity I'm comfortable? Can you still do that act?
I think you absolutely can, and I think that this is a time to really be thinking about that thematic trade of what's going to happen in the next few years, right? So we look at something like Tetra Tech that does all sorts of engineering and construction, but basically on a lot of water and some of the infrastructure stuff. I think that you can definitely look at companies that have a longer-term theme that are playing into some of the things that are going on, but the volatility within that, you have to be able to say, okay, this is where I will allow some volatility to occur, because some of those stocks that we like a lot still have had some challenges in a year where someone makes an acquisition or somebody does something. But I think you can look at thematic investing now because you really got a longer term view and you've got a market that's fairly expensive. So you better really like where you're positioned.
Let's finish on the banks, the regional banks specifically, not the big players, the regionals. KRE, closely followed regional bank ETF, you know them well, up almost 14% in November, up 16% in December. Is that just a leverage trade on what's happening in the bond market? in Treasuries as yields fall aggressively, or is there something to get your hands around for 24?
I think that's a lot to do with what's going on with interest rates, and I think it's also a lot to do with people looking for, okay, where has completely still been on the floor, and maybe we can pick something up here, because the valuations on that group were very, very not challenging relative to the rest of the market. I think you still have issues with the yield curve. I think it's still difficult to make some money in some of those, and I think we still have commercial real estate issues that we haven't flown through yet. So it's a little bit challenging to say that that's a definite thing about the environment, as more as like it was being picked up off the floor.
Speaking of the yield curve, Lisa, 2-year versus 10-year, still negative 36 basis points.
They're not going to really make up some of the difference through lending long and borrowing short. To also Sarah's point, $117 billion of commercial mortgage debt coming due just this year alone. That's really going to raise some questions on that front with some of these regional banks.
I read the same article. I believe it was in the FT. My brain's frozen on that right now. But the answer, John, is I saw a bar chart of, I'm going to say, 10 cities in America. There's basically New York, and sum up all the others, and maybe every other city combined is the same as New York. I mean, it's amazing how this is a local issue for us.
Hey, Sarah, it's good to see you. Happy New Year. Sarah Hunt there of Alpine Saxon Woods.
Let's quickly get to Terry Weissman of Macquarie here on global FX and all the other things that get us back to a great bull market in the United States. Wonderful to have you, Dr. Weissman, to get us started for the year. Let me go to the larger view, which is everything hinges on China. Do you agree?
Not for 2024, no, although I do think that China is a very important part of the macro story globally. We have the central banks in the U.S. to worry about. We have the central banks in Europe to worry about. And we have supply shocks, especially in the natural resource markets and the oil markets to worry about, too. So China is important, but it's not all or nothing as it comes to China. I will say this, though. I think the market is somewhat wrong in focusing too much on the property sector in China and aggregate demand in China. I think what the market has lost sight of to some extent is President Xi's willingness to go after the tech sector in China, and more generally, against the whole concept of private property in China. I think this is what is souring sentiment for China, and I think to the extent that finds some relief in 2024, right, it could be a bigger deal for China on the upside than some resolution to the problems on the balance sheet of the property sector.
There's been a multi-decade failure of international stocks, and some would correlate that over to an ever stronger dollar. Is the dollar finally broken where there's an unspoken opportunity in international equities?
Well, if you're asking, is the dollar as a reserve currency as the standard for international trade and international finance is over? No, I know. I don't think so. If what you're asking for is there going to be a structural break with regard to the status of the dollar in international capital markets and international trade, I think the answer is no. Remember that we had a period before we had globalization, before 1995 for that matter, when China and Russia and the other emerging markets were not that fully integrated into the global economy or the Washington Consensus for that matter, and yet we still talked about the dollar as the reserve currency of the world. Why? Because a good part of the world still depends on the dollar for its trade and for its commerce and for its financing. So no, I don't think that's going to happen anytime soon, at least.
One of the charades that we do at the beginning of every year is to come up with potential tail risks, which inevitably will probably be wrong. But there is a question here. Tail risk of the dollar being somehow profoundly debased seems to be off the table from what you just said. What about sort of the tail risk of some sort of significant supply shock? You sort of alluded to that initially in the commodity space.
No, that I think is a bigger tail risk. And I think it behooves every investor out there to at least have some oil in one's portfolio. Be long oil, because when you think about U.S. recessions in the post-war period, you'll find an amazingly large number of them had been preceded by a rapid rise in oil prices. You'll see that, and it behooves investors to have some oil in the portfolio because we just don't know. To the extent that we do have a supply shock, oil prices will go up, and you'll offset the losses you would otherwise experience from seeing stocks go down, from seeing bonds go down in that context.
Well, this raises a question to me of how offsides the market would be should there be some sort of oil supply shock, given the fact that people have kind of gotten accustomed to the idea that the U.S. is producing record amounts, right, and that even in the face of conflict, oil prices went down. How wrongly positioned our people for this kind of event?
I don't know how wrongly positioned they are. There is a case to be made, however, for the logic of oil prices having come down in the last few months. And the logic is very straightforward. The elasticity of supply in oil is actually quite high, and potentially higher than the market surmised before 6 months ago. What we have seen with the increase in oil prices that preceded this decline is a huge increase in oil production in the U.S., and that is the basis for why oil prices are down. But if we were to get a shock out of the Middle East, for example, a shock out of Russia, it's not conceivable that production can go up quickly enough to offset that in a very short period of time. And that's the risk that we face right now from these shocks. Over the long term, there'll be an adjustment in U.S. supply that's positive and beneficial, but not in the short term.
Is the US dollar a commodity currency now?
No, I don't think so. Certainly the market doesn't see it that way, right? It's interesting. There are some emerging markets that we don't necessarily associate that much from the perspective of their current account balance and their trade with oil, because they're not huge net exporters, Brazil, for example, but they are large producers. And yet the market tends to associate the Brazilian real with oil more than it does associate the US dollar with oil.
Do you expect that to change anytime soon?
No, I don't think so. And that's because no one's going to really associate the U.S. With a very large net export balance in oil. It really has to get to a point where U.S. trade is dominated by oil, and that is not the case yet. It's still dominated by services and technology.
Very true. TK, the number's just absolutely staggering when it comes to production. 13 million barrels a day in this country.
Yeah, well, what's interesting is we don't have an oil policy. I mean, we take great pride that Washington has never come up with the plan. We've got this plan, that plan, whatever plan. I guess it's a technological success.
Not sure we need one.
No plan.
Well, to that point, do we need one? Is Washington, is the White House irrelevant with regards to this conversation?
Only in respect that oil is such a geopolitical issue. And of course, geopolitics and politics generally have to be managed either through diplomacy or through some management of market forces that are relevant to geopolitics. There's a case to be made for the energy market to be managed from that perspective. But if it wasn't for the importance of oil from a geopolitical perspective, I don't think so.
Terry, it's good to see you.
My pleasure.
Happy New Year. Thank you, sir. Terry Wiseman there of Macquarie.
We're beginning strong this year, and part of that is with Doug Cass, who, as many of you know, out in social media at Seabreeze Partners, is a great piñata. And Doug, before we get to your, always interesting, thought-provoking 10 ideas, if I'm cautious on the market, or if I'm short on the market, and the market runs away from me the other direction, what do you do? What'd you do in December? Given this bull market leg up, how did you respond?
We were short in two time frames. One was timely, May to after July, after the May-July run, but we didn't lose money in the May-July run, and we were net short in November and December. We didn't lose money either.
How do you do that? I think a lot of people want to know, Doug.
Yeah,
how do you not lose money?
Tough. It's tough. To begin with, why did I get it wrong in the last 2 months? I think I underestimated the animal spirits and the price momentum that had been accumulated. I underestimated the power of the herd as the pressure on the upside intensified, and so did FOMO. I underestimated the contribution from market structure, which had basically intensified the upside to equities, and the same applies to interest rates. The momentum and the yields to the downside accelerated. And, we live in a market which has a structure. It's far different than I started when I was a housing analyst at Kidder Peabody. Buyers live higher and sellers live lower, so you have to adapt. Warren Buffett said the first two lessons on investing, don't lose money, and the second lesson is don't forget the first lesson. So we trade opportunistically around short positions, and I'm risk averse because my short book is pretty diversified. And when I'm wrong, I take a lot of small losses. That's the answer. Mm-hmm. But as we enter the new year, I am net short.
So how do you think about here this 2024? Again, I think the late October through the year end 23 caught a lot of people by surprise by the vigor of that rally here. So what do we do here on January 2nd?
Well, I always find it amusing that there is now a universal view almost after the quantum rise, especially of the NASDAQ, that the markets are headed higher. However, I think it's important, Paul, to observe how wrong the confident consensus has been in each of the last 2 years. If you remember, in the end of 2021, the herd was optimistic, and 2022 was a disaster. We had such a bad experience in 2022 that the consensus ended that year wildly confident, and that especially, but this time bearish, especially on tech stocks, and that couldn't be further off sides. Today, the consensus following the momentum is very bullish, and an area bear can be found. In fact, many of the bears that I watch when I'm on the Death Star CNBC have now become bulls. So I see a vast array of unexpected political, geopolitical, economic, and market surprises that could be untapped for next year. And my biggest concern is the equity risk premium. And despite the enormity of the drop in yields, the equity risk premium is still paper thin. And historically, this is a reasonable predictor of weak markets.
Paul, Apple, PE present 30.
Yeah, exactly. Doug, surprises for 2024. What should we we're not thinking about, but maybe we should?
Sure. I think one of the things we're not thinking about is in part due to fear that the Democrats will continue to hold on to the presidency. Foreign powers step up military confrontations. And my second surprise, is that the West continues to lose patience with how the war is going with Ukraine as the U.S. backs off in its support. And negotiations of a territorial split began, and Ukraine is forced to give up the east side of the country. North Korea, with support from Russia, undertakes skirmishes in the DMZ and makes threats to invade South Korea. Iran completes its nuclear buildup, which provides a direct attack from Israel. Though China doesn't invade Taiwan, it continues with aggressive war game tactics in the South China Sea. So my feeling is that the global economy, Tom and Paul, are more susceptible to supply shocks than is generally believed. And with Russia and Saudi conspiring on production cuts, I wouldn't be surprised that the price of oil exceeds $110 a barrel.
Wow.
And the price of a gallon of gasoline in the U.S. approaches $6, and shares of Exxon, Oxy, Chevron each rise by a third during the year.
Doug, I want to get this in. Surprise. It's so important within all of this. You really go after the Blackstones, the Apollos of the world. You say private equity, quote, to get torn to shreds. Discuss it. That's important for global Wall Street.
Sure. Surprise number 7 is Wall Street's most vicious vultures, private equity, are about to get torn to shreds. And remember, we still, Tom, have elevated interest rates, and we have a slowing global economy. We have the loan rate reset cliff beginning at the last half of this year, and I think it's going to contribute to a leader in private credit failing. Blackstone shares could drop by a third after the BREIT, which is a private real estate fund run by the company, and their public fund, BXMT, come under new redemption pressures. And finally, I wouldn't be surprised. Now, I was involved as a director of a business development company in the New York Stock Exchange, and I personally saw vividly the phony marks in our books. So my surprise is that shares of private equity stocks like KKR, Apollo, and Blackstone plunge as the SEC opens an investigation into the failure of the private equity industry to realistically mark to market their portfolios in a timely manner.
Wow, interesting. Because that's been an issue for a long time, particularly now that these companies are public. How about private credit, Doug? This is a new business for you, Tom, and me over the last decade or something. It's just exploded in terms of size. We were all comfortable with, or we think we understand private equity, but private credit has become a huge business, and it just doesn't feel like it gets the regulatory scrutiny that maybe it deserves.
It doesn't get the regulatory scrutiny at all, Paul.
Yep.
It's hurting the banking industry. It's one of the reasons why I'm so negative on banks, besides the credit cycle, the emerging credit cycle. So this is something to watch. Whenever there is such a quantum increase in balance sheets as there are currently in private equity, we have to be on the alert.
Yeah. Speaking of alert, Doug, I got time for one question. I read my Padres and Red Sox, The Athletic coverage this week. I'm sorry, Juan Soto, for the dreaded New York Yankees, he's basically Wade Boggs with power. That changes the Yankees lineup, doesn't it?
It's a massive move for the Yankees. Our team has lacked left-hand sluggers in recent years, and we never had the necessary lineup support for Aaron Judge. Remember, he bats left-handed,
right,
and he's fully capable of taking advantage of the short porch in right field at Yankee Stadium. I think we're one Jordan Montgomery type away from a World Series. But the problem is Montgomery, Montas, Manea, Lugo, they're all going, they're all signing. But this is a powerful lineup with LeMahieu, Soto, Judge, Rizzo, Stanton, Torres,
20 seconds. Doug Cass, could you do something about the food at Yankee Stadium?
People that live in glass houses in Fenway Park shouldn't be critical.
Doug, thank you so much. Doug Cass with CB's Partners. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.